Thank you for the opportunity. Yep, I'm the co-head of the tech team at Polar. I've been here for a long time. We're one of the larger tech teams in the UK and the world. And yes, it's been a tremendous year for technology. But I think just to contextualize what we go on to talk about, I think it's fair to say that it really has been a fantastic decade. And it's interesting hearing the world from the perspective of a healthcare manager, but from a tech manager's perspective, really the story of the last 10 years has been about tech disruption. And probably the most powerful slide I have in our deck is here on the left-hand side, which just shows you that really all the progress made by equity earnings since the financial crisis have really been driven by tech stocks. That's growth in what we do, and it's the disruption of other profit pools. And it's ended with an incredible divergence of fortunes, and really an important observation, not least because obviously COVID will be has proven beyond any reasonable doubt the criticality of technology. But I think people naturally like to bookend things, and so with an asset class like technology or a sector like technology, very tempting to say, well, with the pandemic behind us, with a vaccine available, what next for tech? I think what this chart says is that the technology sector story began well before COVID, will persist long after it, and it's evidenced by this divergence in fundamentals that we've seen, and that is in a real contrast with the late 90s, a period that people associate with some pockets of valuation excess that we see in the market today, perhaps, but a very different starting point to the one that we're in currently. And you can see that here. In 2000, there was a very brief window where technology earnings outstripped the broader market. This time around, we've had a decade-long period of technology fundamental outperformance, and you can see that in valuations where today the sector accounts for maybe 27-28% of the S&P market cap, but roughly 23-24% of S&P earnings. In stark contrast to the late 90s, when the tech.com bubble saw the sector get to more than 32% of market capitalization, but only explaining 13 or 14 of earnings. So a profoundly different starting point for what we're going to go on to discuss. And so, Oliver, if you wouldn't mind flipping on, for anyone that follows our work, we lean heavily on history as a guide for what's coming next. And in our last annual report, we made the argument that said that, well, the pandemic was likely to be an accelerant to technology in the same way that World War II was previously. And for those that follow that period or know the history of it, huge advances were made during World War II in the field of medicine, things like mass production of penicillin, immunization of tetanus and blood plasma and EpiPens and all sorts of stuff. In the world of aerospace, the jet engine, rocketry helped us get to the moon, and of course lots of other stuff, not least the first digital computer at Bletchley Park. World War II was a huge accelerant for technology trends that were anyway happening, and COVID has proved the same. And so the key business imperative going into COVID has been this concept of digital transformation. Companies needing to look more like Facebook and Amazon to remain pertinent in a smartphone-centric world where Gen Z are growing in the mix, and expectations are profoundly different to older generations. And what we've seen during the pandemic, like World War II, is a huge acceleration because needs must. And Satya Nadella summed it up very aptly early in the crisis when he said 2 years of digital transformation in 2 months. Now, if you flip on, you'll see that transformative backdrop. Sorry, next slide. The transformative backdrop is widespread, and so things like e-commerce, fairly obvious. The online shopping had been taking roughly 1% market share from retail sales on a per annum basis, and then COVID happened, and we jumped from 16 to more than 33% of sales online. For the first time, 20% of shoppers in the UK had never been online were coming online because, again, needs must. Cloud computing, despite the fact that IT budgets are falling, has managed to maintain its incredible growth trajectory. And cloud remains for us, the kernel of this cycle, really the backbone around which everything else is being re-engineered. Payments as a theme has broken out. What was an ancillary theme to e-commerce has now become a theme in its own right, because shops are closed, because we've been online, but also because cash is being, cash is being used as a store of wealth by some people, but as a transactionally, cash is becoming far less interesting. Video conferencing, really a market that has never broken out of a very small category has become synonymous with this crisis. 300 million people a day using Zoom, and obviously lots of other platforms doing very well, very much synonymous with this crisis, and a key, I think, something that will persist long after it. The robotics industry has had a new lease of life. It's a crisis built for robots. Social distancing has accelerated the use of cobots in factory settings, in restaurants, and we're seeing things like electric vehicle mixed materials in cars, also now a driver for robotics. The EV space, obviously a huge beneficiary of the crisis. We saw a more than 50% increase per year over year in European EV sales in the first half of the year, in stark contrast to overall car sales. So hitting an inflection point in EV. And then telemedicine, the idea that you would exchange a physical visit with a doctor for something, technology was probably an anathema before the pandemic. And we've had 10 years of change in little more than 1 week, according to one industry participant. So huge acceleration across the piece as a result of the pandemic. Next slide, please. The natural conclusion would be, well, okay, but we're going to snap back to an old world because we're all miserable with the current one. Unfortunately, history as a guide says not. If World War II was an interesting analog for the acceleration we've seen, so I think it provides us with a very useful template for what happens next. So, excuse me if you will, we step back to 1945, Winston Churchill's looking out on the crowds and celebrating his victory, and then fails miserably to do what David Lloyd George did, to win re-election. And in fact, he's replaced with a Labour government with a platform and a consensus for social change. That is what I believe is going to happen next, post-pandemic. Rather than a snap back to an old world, I think we're going to see very widespread change occur. And the principal reason for that is that we've proven that new work patterns are possible. This concept of work from home will give way to a broader definition of work from anywhere. And people in my team will be able to quite rightly say, I have worked effectively, maybe more effectively, from home than I am in an office. And so I would like a new social compact between you and me, in much the same way that the UK electorate demanded the same from their government post-war. And I think what that means is that we will work from anywhere. That will persist. We may do 3 days in the office, we may do 2 days out. Whatever that mix is, it has huge implications for business travel, for conferences, for any business that has high levels of fixed assets, for commercial property. And we're beginning to see, of course, the beginning of this in deurbanization. So post-World War II, fascinating, I think at least, the creation of new towns, Peterborough, Milton Keynes, Hatfield, Welwyn Garden City, designed to alleviate a housing shortage, but also take pressure off London. We are seeing the beginnings of this already during COVID, where people moving out of cities into rural destinations. You're seeing it in rural property prices. The creation, the advent of so-called Zoom towns like Sacramento, where people are leaving San Francisco, moving to Sacramento for a better life. And the implications for things like mass transit systems are mind-boggling for commercial property, for pret-a-manger, for whatever it might be. The history as a guide says that the old patterns of work are gone. After the war, fascinating, the agenda that we saw, social change was about provision of universal access to secondary education in the Education Act of 1948, but also the development, of course, of the welfare state epitomised by the NHS. I believe that this crisis has demonstrated alternatives to the sort of the postcode lottery that is healthcare provision and education today. Where you live has a huge impact on the outcomes for both of those things, for your child's education, for your healthcare, and so on. And I think that we're going to see that profound change. In fact, I think COVID has given us a glimpse of the future in 100 million children being taught from home or Google Classrooms or Zoom as a platform, people being not only educated but using telemedicine, AI chatbots. And I think, truth be told, we're not going back to a world where people would sit in doctors' offices with other sick people waiting to see a doctor when they felt unwell. And in fact, we're moving to this idea of remote provisioning of key services, which I think will have a really big impact on healthcare and education, two areas that have been relatively unscathed by tech disruption during my entire career, more than 20 years in tech. Other interesting observations might be, the idea that a V-shaped recovery is just wishful thinking, much like our hopes that war would be over by Christmas. V-shaped recovery didn't happen in the UK. It took to the 50s for the UK economy to recover its 1939 levels, in part because of debt overhang. let's not forget, both the US and the UK will leave this crisis with more than 100% of GDP in debt, and that's not ideal from a growth perspective. And I think we might also be looking from a long-term perspective at maybe the peak of US power, Pax Americana, much like World War II sort of spelt the end for British hegemony. Anyway, let's move on. Bringing back to tech, the key is that if you don't snap back, what happens? And the answer is that the next generation technologies that we've grown accustomed to that have been accelerated during this period, things like cloud computing or digital payments, e-sports, telemedicine, electric vehicles. These ideas, these new technologies, of course, if you flick on, Oliver, they don't stay new technologies, they just become the default. So cloud computing is just computing, and alternative energy becomes energy. And of course, what this says is that our investment backdrop should remain a very fertile one over the coming decade. On the next page, just a quick reminder, we run about $12 billion across 3 different mandates, but key to our technology approach is this idea of identifying core themes. I'm not going to talk about the products themselves, just the themes very briefly. These themes are all driven, secular drivers, and they've been investment focuses for us for many, many years. Online advertising, proving its criticality with people finding customers direct to consumer, the need to drive traffic. We've got e-commerce we've talked about, payments we've talked about. AI story I'll come back to, but again, just scratching the surface of AI today. The cloud remains the core platform for change, lots of different ways of playing that, the big guys, but also some software stories. Next slide, please. Software as a service, the idea of software ultimately, these are some of the best assets on earth. We've loved them for more than a decade. Still some incredible agents for change, wonderful business models. Over the top, digital entertainment, factories of the future, and then lastly but not leastly, 5G and in there, electric vehicles and other endpoints that will over time evolve into things like autonomous vehicles and other intelligent agents. The idea of the portfolio is ultimately, on 21, please, is the idea that our portfolios give you a diversified exposure to those themes, and as these squiggles hopefully demonstrate, we move money between them as we see the best risk reward or the best opportunity sets. And so right now we have more than high exposure to things like mobility and 5G. We have a high exposure to some of the digital entertainment stories like Spotify, Netflix, and the gamers. And we've been disallocating from some other areas like, for example, software, where valuations are at cycle highs. Next page. Quick, just touch on valuations quickly. Again, I've already referenced the fact that we don't believe that the 90s bubble is a useful guide. The investment backdrop that we're in today is unusual. I think deflation remains still a very excellent risk. I think policymaker support is very unusual. Quarter of the world's bond market trade with negative yields. So, of course, tech stocks are going to be more expensive than they were 10 years ago, but they remain miles away from where they traded in the late 90s. And on a relative basis versus the S&P, at least, we trade today at 1.2 to 1.3 times the market multiple, as compared to more than 2.3 times at the peak of the 90s. However, on the next slide, you'll see that there are pockets of exuberance. Some of the software stocks look expensive. Again, unusual investment backdrop, wonderful assets, M&A that's supportive, but not much room for disappointment. And that's why we've been reducing our exposure there. And similar on the next page, the spread between winners and losers looks reasonably wide right now. And so we've been reallocating from some of the more expensive names into reopening trades in e-commerce, travel-related assets, robotics, and some of the semiconductor companies with exposure to electric vehicles and 5G particularly. Nearly finished. If you flip to the next page, quickly on AI. So when we're done with pandemic and when we're done with the cloud, which is roughly, we think, about 30% penetrated as a percentage of overall computer workloads, what next? And of course, the answer is AI. About 3 years ago, we launched an automation and AI product because we saw the long-term potential associated with this group of technologies that will ultimately permeate through everything. And something that Gartner called out many years ago. Why now? Because in the end, we have huge amounts of data that's being created in the cloud natively, or the interactions that we are involved in are just multiplying at a rate of knots. The cost of computers collapsed. We have dedicated silicon built for AI workloads. We have cheap storage, and yet only 1% of the world's data is currently stored and analyzed. And again, that's why we're still scratching the surface. Now, on the next page, Key moments, of course, in AI in our lives. The one that I think many people of my generation remember will be IBM beating Kasparov. That was a big deal. And more recently, the IBM supercomputer that beat human competitors using natural language on the Jeopardy game show in 2011. Again, ancient history now, but what's fascinating is, again, this idea of man versus machine or human versus machine, never far from our thoughts. And on page 27, you'll see that since then, AI has not just reached human levels of capability, but superhuman levels. So there's no point playing Go anymore, because in 2016, AI neural networks from DeepMind, now Google, solved for that game. Likewise, in 2017, that same neural network was repositioned to learn the game of chess. And it did that in 4 hours by playing itself. And with that ability, was able to beat the world's greatest chess program, Stockfish. Again, lots of detail, but trying to imbue with the idea that AI is happening as we speak. 2018, the same neural network, was turned and sold for a game called StarCraft, a popular online game from Activision. And then last year, a massive achievement, a neural network from Carnegie, Facebook, sold for poker. So don't play poker against a computer because it's been solved. And that was done, and by the way, in live play, no supercomputer that takes up your room, just the power that would have been on your laptop was able to beat 12 human players over 10,000 hands. The next page, I think, is also hugely interesting. A few years back, we got to a stage where the error rate in language processing reached that of a human. 2017, we show here, I think it was Google that first managed to get to a level roughly in line with the human level, which are around 4%. But since then, we've moved on hugely. And these TLLGs, they're hard to say, have reached now 98% levels of accuracy. And that's why, by the way, your Amazon machine works so well, and why Siri works so well. And we're beginning to see how AI can move into areas like conversational commerce, can actually correct our work. We're moving at the edges into real-time translation. So huge potential to come from natural language processing. And on the next page, you're also beginning to see how AI can create content. So this is a screenshot from a game that was built by NVIDIA to celebrate the 40th anniversary of Pac-Man, my favorite retro game as it happens. And this game was built with no underlying game engine, just a neural network watching hours and hours of human and simulated play and creating the game in its image. This is a portrait made by a neural network, a GAN, that competed against another neural network by first being force-fed thousands of portraits and then creating portraits, and then the other neural network being paid effectively to detect if it was real or not. One of those went on to be sold at Christie's for $500,000 in 2018. And on the right, this incredible experiment of using this GPT-3, one of the most incredible neural networks, to build that content that was written entirely by computers. And again, scratching the surface, just a reminder that AI remains, we're still very, very early in what looks incredibly powerful as a medium-term driver. I think we may nearly be there. Last slide, I think, Oliver. Oh, there goes Pac-Man. Oh, no, not quite. And so today, where can you see AI? You can see it at Facebook, a platform built on data. You see it at Netflix, where the thumbnail that you select is personalized for you based on your habits, your tastes. You only have 2 seconds to choose, pretty much, as a human. Look at Spotify. It's Discover a Weekly playlist built on 100 billion, effectively, data points a day. Data platforms, the ability at Axon to take millions of hours of policing footage and be able to automatically redact and review footage. It changes the face of policing. And of course, there's Uber, 100 petabytes of data and a business built on that data, and things like journey optimization, billing, dynamic pricing, and so on. So to conclude, which I hope is the next slide, the disruption that we've seen in tech, the backdrop for technology investing didn't begin with the pandemic. The pandemic has been an accelerant for sure, and things will settle down in some categories and not in others. But the disruption that began before will persist long after. And in the end, it's because the internet, like steel and like electricity before it, is a general purpose technology around which everything gets recreated and reimagined. And so it's possible that we'll see rotation in the broader market away from tech, and every dog has his day. But the pre-COVID world has gone. There is no returning to that world, in my opinion. And I think rather than a snapback, we should all expect very profound change in the years ahead, driven by technology. And in the not too distant future, AI will continue to infuse our space. Sorry if I've overrun. Hope it was useful. And thank you very much, Jane, for the time.